I am going to speak to you today about a subject that usually empties the room at high society dinner parties. If I were running for office, this is the speech that would lose me every single vote from the donor class. But I am not running for office, and I have enough money to buy my own dinner, so I am going to tell you the truth. The truth is about the peculiar, irrational, and largely useless profession of active money management, and the simple, boring, effective alternative that drives Wall Street absolutely bonkers. I am talking, of course, about index investing. Now, you have to understand something fundamental about the way the world works. It is a very simple concept, but it is amazing how many people with high IQs and expensive suits manage to ignore it. It is the concept of arithmetic. It is the iron rule of the universe. If you take all the stocks in the world and you put them in a basket, basket represents the entire market. The return of that basket is the return of the market. That is a tautology. It has to be true. Now, if you have two groups of people owning that basket, Group A, the index investors who just hold the basket, and Group B, the active managers who trade back and forth trying to be clever, the average result of both groups, before costs, must be exactly the same. They are all owning the same basket. But here is where the stupidity creeps in. It creeps in with the friction. The croupiers, the helpers, the people who stand between you and the basket and demand a toll. Group B, the active managers, they have high costs. They pay for research. They pay for trading commissions. They pay for fancy offices in Manhattan and London. And most importantly, they pay themselves enormous fees. Group A, the index investors, they pay almost nothing. They sit on their derrieres and do nothing. So, simple arithmetic tells you that Group A, the people who do nothing, must, as a mathematical certainty, outperform Group B, the people who are trying very hard. This is not a theory. This is fourth-grade math. And yet we have an entire industry, a massive global, multi-trillion-dollar industry, built on the premise that this arithmetic does not exist. They tell you that if you just pay them enough, they can defy the laws of mathematics. They are selling you magic. And if you buy it, you deserve the result you get, which is usually a kick in the teeth. I have spent a long lifetime watching people make this mistake. It is the mistake of confusing activity with achievement. In most parts of life, if you work harder, you get better results. If you are a pianist and you practice 10 hours a day, you will be better than the fellow who practices 10 minutes. If you are a surgeon, you want to study the latest techniques. But in investing, this rule is inverted. In investing, the harder you try, the more you trade, the more you tinker, the worse you do. The guy who buys the S&P 500 index fund and goes fishing for 40 years will arrive at retirement with a mountain of cash. The guy who spends those 40 years reading charts, listening to CNBC, and paying a manager to pick winners will arrive with a significantly smaller mountain. The active manager has eaten the difference. You have to ask yourself, why does this persist? If the evidence is so clear, and it is clear, the data is overwhelming, why do people still flock to active managers? Why do pension funds, who have a fiduciary duty to not be idiots, still dump billions into hedge funds that charge 2 and 20 for the privilege of underperforming a brain-dead algorithm? The answer lies in human psychology. It is the Lollapalooza effect of several psychological biases working in tandem to make smart people stupid. First, you have the Lake Wobegon effect. Everyone believes they are above average. You ask a room full of drivers if they are better than average, and 90% raise their hands. That is statistically impossible, but in investing, it is lethal. You believe your manager is special. You know the as-average manager can't beat the market, but your guy, he's different. He went to Wharton. He has a proprietary model. He has a nice handshake. This is delusion. The number of managers who have a true, durable edge that exceeds their fees is so small it is almost a rounding error. I know a few. Warren is one. There are perhaps a dozen others I would trust with my own money. But the odds of you finding them are lower than the odds of you finding a needle in a haystack. And the haystack is on fire, and the needle is charging you a 2% management fee. Then you have the bias of social proof. If everyone else is doing it, it must be right. Your brother-in-law has a broker. Your boss has a wealth manager. The endowment of your university has a sophisticated portfolio of alternative assets. So you think, I must do that too. You don't want to be the simpleton owning a generic index fund. You want to be part of the club. You want to feel sophisticated. Complexity sells. Simplicity does not. If a man comes to you and says, "Give me your money, I will put it in a total market index, and we will never talk again until you retire," you think he is lazy. If another man comes to you with colorful charts and talks about alpha and beta and standard deviation and sector rotation, you think he is a genius. You pay the genius to lose your money, and you ignore the lazy man who would have made you rich. And let us not forget the most dangerous bias of all, envy. Envy is a really stupid sin because it's the only one you could never possibly have any fun at. There's a lot of pain and no fun, but it drives the investment world. You hear that your neighbor bought Tesla options and made a killing. You hear that some hedge fund manager shorted the pound and made $1 billion. You get envious. You don't want the market return. The market return is boring. The market return is slow. You want the lottery ticket. You want to beat the other guy. The active money management industry thrives on this envy. They are the croupiers in the casino. They dangle the winners in front of you. Look at this fund! It's up 40% this year! They don't tell you it was down 40% the year before. They don't tell you about the other 10 funds they closed quietly because they went to zero. They just show you the winners. It is a performance. It is theater. And the ticket price is your net worth. Let's look at the history of this. It wasn't always this crazy. Go back to when I was young, which I admit requires a very strong memory. And the world was different. There were fewer people trying to outsmart the market. If you were willing to do the work, if you were willing to turn over rocks, you could find things. Ben Graham could find companies trading for less than the cash in their bank accounts. It was a gentleman's game. There was inefficiency everywhere. But now you have millions of people, armed with computers that operate at the speed of light, all scouring the same data, all fighting for the same scraps of information. The competition is brutal. It is an arms race. And what happens in an arms race? The weapons get more expensive, but the relative advantage shrinks. The market has become remarkably efficient, not perfectly efficient. I don't believe in the efficient market hypothesis in its extreme form. That's academic nonsense, but it is efficient enough that for the average individual, or even the average institution, trying to beat it is a fool's errand. And yet the fees have not come down. That is the great scandal. In any other industry, as technology improves and efficiency increases, prices drop. But in asset management, the fees stay high. They charge you a percentage of assets. As the market goes up, their fees go up. They didn't do any extra work. They didn't get any smarter. The tide just lifted the boat, and they skimmed the foam off the top. It is a racket. I have often said that a lot of what goes on in finance is rat poison. And I mean that it is toxic to society. When you have the smartest minds in the country, the physicists, the mathematicians, the engineers going into high-frequency trading or hedge fund management, that is a brain drain. They are not building bridges. They are not curing diseases. They are writing algorithms to exploit a fraction of a penny difference in the price of a stock between New York and Chicago. It adds no value to civilization. It is rent-seeking. And the index fund is the antidote to that poison. The index fund says, I opt out. I opt out of the rat race. I opt out of the fees. I opt out of the stress. I opt out of the delusion that I can predict the future. The index fund is the ultimate act of humility. And in the markets, humility is a superpower. The arrogant man gets crushed. The humble man endures. Now, some people say, but Charlie, if everyone buys index funds, who will set the prices? Won't the market break? This is the standard argument from the active managers who are terrified of losing their fees. They scream that passive investing is dangerous. They say it distorts capital allocation. To that I say hogwash. We are nowhere near that point. We are nowhere near having 100% of the market in index funds. There will always be enough speculators, enough gamblers, enough people with egos too big for their brains who will trade and set the prices. Let them do it. Let them pay the costs. Let them create the liquidity. You just ride along for free. You are the stowaway on the ship that they are rowing. Let them row. You just sit on the deck and enjoy the breeze. It is amazing to me how hard it is to teach people to do nothing. Pascal said, "All of humanity's problems stem from man's inability to sit quietly in a room alone." That is true in life, and it is doubly true in investing. You feel the need to act. You watch the news. The news is designed to scare you. Market crashes! Inflation soars! Recession looming! Your cortisol spikes. You call your broker. Do something. You scream, "Get me out!" And the broker says, "Sure, I'll get you out." And he charges you a commission. And then 6 months later, when the sky hasn't fallen, you call him back. "Get me back in." And he charges you another commission. You have just transferred a chunk of your wealth to him. You have interrupted the miracle of compounding. You have committed the cardinal sin of interrupting money while it is working for you. The index investor doesn't have this problem. He doesn't have a broker to call. He doesn't have a decision to make. The market goes down, he buys more automatically. The market goes up, he buys more automatically. He is relentless. He is like a glacier. He moves slowly, but he crushes everything in his path. I want to talk about the morality of this for a moment. I believe there is a moral duty to be rational. If you are a trustee for a charity, or a pension fund for teachers or firefighters, and you are paying 2% fees to a manager who underperforms the index, you are not just being stupid. You are being negligent. You are taking money out of the pockets of retirees and putting it into the pockets of Hampton's homeowners. It is a transfer of wealth from the deserving to the undeserving. Jack Bogle, the founder of Vanguard, was a hero. He was a secular saint. He did more for the American investor than anyone else in history. He created the index fund. He drove costs down. He put billions of dollars back into the pockets of ordinary people. And for this, he was hated by the financial establishment. They hated him because he took away their punch bowl. He exposed the game. He showed that the emperor had no clothes, and that the emperor was charging a very high fee for his nudity. You should worship at the altar of Jack Bogle. You should look at the expense ratio of your investments with the same scrutiny you use when you look at the price of a car. If you are paying 1% a year in fees over 30 or 40 years, that 1% doesn't sound like much. But do the math. The power of compound interest works against you just as hard as it works for you. That 1% fee will eat up 30% or 40% of your final nest egg. You are giving away a third of your life's work to a guy in a suit who did nothing but pick up the phone. Does that sound rational to you? If you buy a car and the dealer tells you, "I will sell you this car, but every year you own it, you have to give me one of the wheels," you would tell him to go to hell. But that is what you are doing with high fee active management. You are giving away the wheels of your retirement vehicle. Now, I am not saying that all active management is evil. There are places for it. In private equity, perhaps, or in very distressed debt, or in small, illiquid markets where there is no index. If you are an endowment like Yale, maybe you can find the managers who can exploit those niches. But you are not Yale. You are a dentist in Omaha. You are a lawyer in Detroit. You do not have access to the top 0.1% of managers. You have access to the ones who are good at marketing, and the intersection of good at marketing and good at investing is practically zero. Usually, if they are good at marketing, they are bad at investing because they are spending all their time selling instead of thinking. The beauty of the index fund is that it eliminates the manager risk. You don't have to worry if the portfolio manager is going through a divorce. You don't have to worry if he's lost his touch. You don't have to worry if he's secretly betting against his own clients. The S&P 500 doesn't have a divorce. It doesn't have a midlife crisis. It just ruthlessly culls the weak companies and adds the strong ones. It is a self-cleansing mechanism. It is capitalism in its purest form. When a company in the index starts to fail, it gets smaller. Its weight in the index drops. Eventually, it gets kicked out. When a new company rises, like Amazon or Google, it gets added. The index automatically rides the winners and cuts the losers. It does exactly what the active manager promises to do, but it does it without ego, without emotion, and without a fee. Why would you bet against that? Why would you think you can do better? People tell me, investing is fun. I like picking stocks. Fine. If it's entertainment, Treat it like entertainment. Take 5% of your money, put it in a separate account, and call it your Vegas fund. Buy your crypto. Buy your meme stocks. Have a ball. But do not fool yourself into thinking this is investing. This is gambling. And like any casino, the house usually wins. For the other 95% of your money, the money you need to live on, the money you need to take care of your family, don't gamble. Be boring. Be rational. Buy the index. I have lived through the Great Depression. I have lived through wars. I have seen inflation at 15% and interest rates at 0. I have seen the Nifty 50, the dot-com bubble, the housing bubble. I have seen every kind of mania and panic you can imagine. And the one constant, the one thing that never changes, is that people get into trouble when they get greedy and impatient. The index fund is the cure for impatience. It forces you to think long term. You can't day trade the S&P 500 effectively. It's too big. It moves with the tide of the economy. It aligns your wealth with the progress of civilization. And over the long term, civilization progresses. Humans are innovative. We solve problems. We invent things. Productivity goes up. Corporate profits go up. If you own a share of that progress, you will do well. You don't need to know which company will win. You just need to know that humanity will win. There is a deep arrogance in the active manager. He looks at the market, which represents the collective wisdom of millions of people, and he says, "They are all wrong, and I am right." To take that stance, you need a lot of conviction, and you better be right. Because if you are wrong, the market will punish you. The index investor has no arrogance. He says, "I don't know who will win. I don't know what inflation will be next year. I don't know when the next recession is coming. I just know that over time, the basket of American business is a good place to be." That humility is rewarded. The irony is that the people who try the hardest often end up with the least. I have seen smart men, brilliant men, go broke because they used leverage to bet on things they thought were sure things. There is no such thing as a sure thing in finance. There are only probabilities. And the probability that you, sitting at your kitchen table, can outsmart a computer algorithm in New York is 0. The probability that an active manager can beat the market after fees over a 20-year period is less than 10%. Those are terrible odds. If I offered you a bet where you had a 90% chance of losing, would you take it? Of course not. You aren't stupid. But when a mutual fund salesman offers you the same bet, wrapped in a glossy brochure, millions of people take it. They sign the check with a smile. It is madness. Let's talk about diversification. Peter Lynch invented that term, and it's a good one. Active managers often hug the index. They are terrified of underperforming, so they buy the same stocks that are in the index, but they charge you high fees for it. They are closet indexers. If you look at their holdings, they look just like the S&P 500, maybe slightly different weightings, but you are paying 100 times the cost. That is the definition of a rip-off. If you are going to own the index, own the index. Don't pay a guy in a suspended suit to pretend he is picking stocks when he is really just copying the homework of the market. And then you have the consultants. The consultants are the worst of the bunch. They go to the pension funds and the endowments and they say, "What can help you find the best managers?" They produce thick books of nonsense. They charge fees to find the managers who charge fees. It is layers of fees on top of fees. It is like fleas on a dog. And the poor dog, the capital, is being sucked dry. The consultant has no incentive to say, "Just buy an index fund." If he says that, he loses his retainer. He has to make it look complicated to justify his existence. Upton Sinclair said, "It is difficult to get a man to understand something when his salary depends on his not understanding it." That explains 99% of the behavior on Wall Street. They cannot understand the superiority of index funds because if they did, they would have to fire themselves. They would have to admit that they are useless, and nobody wants to admit that. So they create narratives. They tell you that active management is a stock picker's market now. They tell you passive investing is a bubble. They tell you you need downside protection. It is all sales talk. The reality is stark. The average active manager underperforms the index. The average hedge fund underperforms the index. The average endowment underperforms the index. The data is in. The experiment has been run. And the answer is clear. The best way to own common stocks is through an index fund that charges minimal fees. Now, I am a stock picker. I have spent my life picking stocks. But I am a freak of nature. I have a temperament that allows me to sit and read for 12 hours a day. I have the patience to wait years for a fat pitch, and even I find it harder today than I did 40 years ago. If it is hard for me, imagine how hard it is for you. Imagine how hard it is for the guy you hired who is worried about his quarterly bonus. You have to know your circle of competence. That is one of the most important mental models. You have to know what you know and what you don't know. If you don't know how to value a business, and 99% of people don't, then you have no business picking stocks. You have no business hiring a manager to pick stocks, because how do you know if the manager is good if you don't know what good looks like? The index fund solves the competence problem. You don't need to know how to value Apple or Microsoft. You just need to know that they are profitable businesses. The market does the valuation for you. You are outsourcing the thinking to the collective intelligence of the world. That is a very smart thing to do. I want you to think about the alternative cost, the opportunity cost. Every dollar you pay in fees is a dollar that is not compounding for you. Over a lifetime, the difference between a 0.05% fee and a 1% fee is millions of dollars. That is the difference between a comfortable retirement and a lavish one. That is the difference between leaving money to your children or leaving nothing. Why would you voluntarily give that up to feed the ego of a fund manager, to feel like a player? It is stupid. And if there is one thing I have tried to do in my life, it is to avoid stupidity. I am not trying to be brilliant. I am just trying to be consistently not stupid. And then paying high fees for active management is really, really stupid. The financial industry will never stop trying to sell you complexity. They will invent new products. They will invent SPECs. They will invent crypto ETFs. They will invent leveraged inverse volatility notes. They will invent things that I cannot even pronounce. And they will sell them to you with a smile. They will tell you that this is the key to riches. Ignore them. Treat them like the snake oil salesmen they are. They are not your friends. They are counterparties. They make money when you trade. You make money when you hold. Your interests are diametrically opposed. The path to wealth is not hidden. It is not a secret. It is right there in plain sight. Spend less than you earn. Invest the difference in a diversified basket of businesses. Keep your costs low and wait. That last part is the hardest. The waiting. The boredom. You have to be able to watch your neighbor get rich on a lucky bet and not blink. You have to be able to watch the market drop 50% and not panic. You have to be able to sit on your hands when every instinct in your body is telling you to do something. If you can do that, if you can embrace the boredom, if you can reject the fees, if you can ignore the noise, you will win. It is mathematically guaranteed. You will end up with more money than the people who tried to be smart. You will end up with more money than the people who chase the hot dots. You will be the tortoise that beats the hare. And let me tell you, being the tortoise is pretty good. You sleep better. You worry less. You have more time to read, to think, to be with your family. You aren't glued to a screen watching ticking numbers. You aren't stressing about what the Federal Reserve is going to do next Tuesday. You are free. The index fund is not just a financial product. It is a philosophy of life. It is the philosophy of accepting reality, minimizing error, and focusing on the long game. It is the philosophy of good enough, and in investing, good enough combined with low costs and long time frames becomes great. So, look at your portfolio. Look at the fees. Look at the turnover. If you are paying for active management, ask yourself why. What are you getting for that money? Are you getting performance? Probably not. Are you getting peace of mind? Probably not. You are getting a sales pitch. You are getting a story. Stop buying the story. Buy the math. The world is full of foolishness. It is full of people doing irrational things because their lizard brain tells them to. You don't have to be one of them. You can step off the carousel. You can fire the helpers. You can simply buy the whole haystack and go back to sleep. It is the most rational thing you can do. It is the most effective thing you can do. And it is the thing that Wall Street hates the most. Which, if you ask me, is a pretty good reason to do it. Don't be the patsy at the poker table. If you look around and you don't know who the sucker is, it's you. In the game of active management, the client is almost always the sucker. The manager gets paid win or lose. The broker gets paid win or lose. The consultant gets paid win or lose. You are the only one taking the risk. Flip the odds. Buy the index. Remove the croupier. Keep the money. It's not brilliant. It's not exciting. It won't make you famous, but it will make you rich. And unlike the casino, the house doesn't have to win, you do. Here is the takeaway. It is blunt, and I want you to remember it. The financial industry exists to transfer wealth from the impatient to the patient and from the ignorant to the informed. If you pay high fees for active management, you are volunteering to be the victim of that transfer. Don't be a victim. Be a rational adult. Buy the index, shut your mouth, and wait.